If you're thinking of buying a home, a VA home loan can help you make it happen. Let's take a look at what VA home loans are, as well as some of the advantages they offer that traditional mortgages don't. A VA home loan is a loan that veterans, active duty service members, and some surviving spouses are eligible to apply for. They often come with better terms than a traditional mortgage and can be easier to qualify for. There are specific eligibility requirements in order to qualify, like the length of your service, which we cover in an accompanying checklist. If you're eligible, you can apply for a VA home loan at any time during or after your service when you're looking to buy or refinance a home, as long as the home will be your primary residence. You can also use a VA home loan more than once, if, say, you end up selling one house and buying another later on. As always, there are a few exceptions. You can check the VA's website to find out if you, or the home you want to purchase, might qualify. VA home loans can offer benefits over a traditional mortgage. One is potentially lower interest rates. Since the VA guarantees a portion of the loan, they are less risky for lenders because the guarantee protects the lender. As a result, lenders might offer you lower rates than you could get with a traditional mortgage. Still, different lenders will offer different interest rates and terms on VA home loans, so it's worth taking some time to shop around for the best deal. Another potential benefit is that you aren't generally required to make a down payment, which means you could finance 100% of the home's value. For a traditional mortgage, lenders often require borrowers to make a down payment of at least 20% of the home's value. If they don't, they typically have to pay private mortgage insurance, which can significantly add to the cost of the loan. But with a VA home loan, you aren't required to pay mortgage insurance if you don't make a down payment. Now, there are other fees for VA home loans, like the funding fee, which we'll discuss later. But if you don't have savings to put toward a down payment, not having to pay mortgage insurance will likely save you quite a bit of money. On the other hand, not putting anything down means you'll be taking out a larger loan, so over time, you will likely pay more in interest. For example, let's say you buy a $180,000 house with a 30-year fixed-rate home loan at 3.5% interest. If you don't make a down payment, you could pay a total of about $291,000 for your house over the life of the loan. On the other hand, if you were to make a 10% down payment of $18,000, you'd end up paying a lot less. You'd have lower monthly payments, and you'd pay about $262,000 over the life of the loan. Adding your original $18,000 down payment, you might pay a total of about $280,000 for the same home. That's a difference of about $11,000. So, as you can see, if you can make even a small down payment, you could save money in the long run. In addition to the typical closing costs and fees, there are two fees specific to getting a VA home loan that are worth noting: the appraisal fee and the funding fee. When you apply for a VA loan, your lender will arrange an appraisal with a VA-approved appraiser. This required appraisal protects both you and the bank by making sure the home meets the minimum property requirements set by the VA. Basically, that the property is safe, structurally sound, and that your purchase price is a fair value. In most parts of the country, an appraisal will cost you around $400 to $500. You can find out what the maximum allowable appraisal fee will be for your region at va.gov.